You know, I don't do regrets. I always tell people I don't do regrets. I don't look back at my life and start wondering, okay, maybe I should have done it this way. No, when I've done it, I've done it. So I make very informed decisions before I make any steps. But even if I don't make an informed decision, because sometimes I'll just slack and then do some things that are just stupid, right? But I don't look back and regret, because that's part of life. That's part of the journey. But today's video, we're going to be looking at something that will make some people regret at why they're not investing. Definitely not me, because I have been investing quite consistently. But if fear is crippling you, if fear is making you not invest, if fear is making you not take risks, if fear is making you not double your money, if fear is making you not start the process of building wealth, this video is for you. And I'm just going to make you look back, not for you to regret, but for you to learn a lesson and start moving forward with determination, focus, positivity, and patience. Otherwise, guys, this is Money Matters as usual, and here we talk about the money mindset, how to make that money, how to enjoy that money, how to manage that money, how to invest that money, and how to assure yourself of a lifetime of income, basically financial freedom. So we're going to be looking at something amazing, the performance of the S&P 500. I talk about the S&P 500, and if you don't know what the S&P 500 means, check out my video on the S&P 500 on how to invest in the S&P 500. I will link it somewhere here, so make sure you watch that one before you come and watch this one. But this is basically how stocks can make you rich and how stocks can double your money. So if fear is making you not invest in stocks, then you are losing out big time. And we're going to do this analysis based on the performance of the S&P 500 now. So if you don't know anything about S&P 500, it's basically refers to Standard & Poor's, which is basically compiling the 500 largest companies in the US. So it puts them in one basket, the S&P 500 index fund, which basically tracks the performance of those 500 largest companies. Those 500 largest companies are divided in terms of the large cap, mid cap, and small cap. Small cap, when I say cap, I just mean capitalization, market size, basically how big those companies are, right? So we have the S&P 500. We have these companies in there as a basket, and then now it tracks the performance of those companies. So if you buy into the S&P 500 index fund, basically what you're doing is you're mimicking the performance of the 500 largest companies in the US. And it's been said this is one of the best and safest ways you can invest in the stock market if you do not want to waste time picking the winning stocks, if you don't have the knowledge to start analyzing stocks and deciding what should you buy, if you do not have the confidence to start thinking, okay, which stock will be the next Amazon, which stock will be the next Apple, which stock will be the next Facebook, which one will be the next Google, which one will be the next Coca-Cola, for example. So you don't want to go into those details because it involves a lot of stuff. It involves a lot of research determining which stock will be good in the next 10 years or even 5 years, right? Because a lot of stocks actually fall off the 500 companies because they go at a loss and they go bankrupt and a lot of things happen. So you don't want to be choosing stocks one by one. So if you don't want that and don't want that hassle, you simply go into a broad index fund which has all the stocks. So what you're doing is you're tracking the whole basket. You buy the whole basket instead of buying individual stuff in the basket. It makes it easier. And I've always talked about the advantages. One of them is low expense ratio. So it's less expensive for you. It's professional. So it's managed professionally. So you access professional management at a very low fee, which you wouldn't actually do if you were to just hire a financial advisor or a portfolio manager or something like that. So there are so many advantages as to why you should invest in the S&P 500. Plus, it's a determined return. So the S&P 500 has given an average return of 10% over the years, and this is statistically proven. So if you invest long term, you are sure of getting that return. You're sure of getting that money. It's something you can actually plan your retirement with, for example, you know. So with regards to just those few advantages I've mentioned, I want to look at the S&P 500 since March last year. So the S&P 500 in March fell down to $2,237.40 per share, and today the S&P 500 is at 4,509, and that is today when I'm making this video. But we're looking at the 1 year performance since March. By that time it had made over 100%. So right now it's at 102%. So within that period of time, the S&P 500 has doubled in value. Now the reason I'm doing this video is to show you that fear can cripple you out of investing. Most people sold their stocks around March when the pandemic struck, and everything was going down. So the S&P went down completely, like it was just crazy. Things were just crumbling. And some people got out of the market at that time. If you are somebody who had been investing consistently, the bull market was running, things were going up, everything was looking good. Then Corona came up and the S&P 500 tumbled. Those who got out of the market or those who stopped investing have lost a big deal. Now, if you lost a good percentage of your money at that time, you have recovered that money 100%. So if you bought some stocks at that particular price, if you bought the share at that particular price, right now you'd have doubled your money. Just imagine that. In just 1 year, you had 100% return on your money. Isn't that an amazing, amazing thing? So if you invested well, then you are definitely raking big money. So what I'm trying to say is that the fear of the market tumbling should not stop you from investing. Invest long term. Don't try to time the market. Don't try to find the market when it's at the bottom, because you can never know when the market is at the bottom. You can never tell. If you do not have the financial expertise to do it, you can't tell. But even the financial experts fail at determining how the market will always perform. Nobody even predicted that the market will recover within 1 year. So don't let fear cripple your investment process. Don't let fear control your investment process. Don't let fear control your wealth building process, because it will mess you up. We don't know what will happen the next year. We don't know what will happen tomorrow with the stock market. Anything can happen. What matters is you stay in the market no matter what's happening. And mostly, you could find that this was a very good bargain for those who know, because when the market went down, those who have learned the process of investing, they bought more shares. They were finding them at a very cheap price, buying them at that cheap price. So if you bought these shares at 2,000 something, now you can now sell at 4,000 something. You can imagine that kind of return. That's an amazing return, a double-digit return. So if you look at it in that sense, you want to make sure that you're not timing the market, you're spending long time in the market. It's not about timing the market. It's about time in the market. How much time are you in the market? Don't try to time it. So that's one thing. So the S&P 500 has doubled. I want to look at some specific sectors. So let's say that you decided, you were not invested in the S&P 500 as a whole. You were just invested in certain sectors. So I want to look at the performance of those sectors during that bull run, during that period. And even if you bought, let's say, for example, the Invesco QQQ, which is basically tracking the technology fund. Let's say the Fidelity Technology Fund, which just tracks the technology companies. So let's say you just chose a particular sector, because besides the index fund, there are those ETFs that only focus fully on a particular sector. So let's say you chose a different sector. You decided, I'm just investing in the IT sector, the healthcare sector, the industrial sector. How have those sectors performed during this time, and what return would you have had on your money if you are investing on those sectors? And then we will drill down from sectors. Now we look at some of the best performing companies in those particular sectors. Not all of them really, but just the best companies. We look at like Apple and the amount of return Apple has given the last 1 year. We look at Amazon, we look at Google, we look at Facebook, and just see how the amazing returns have been. Even if you were invested in some major stocks in the world right now, you would still have made money. So basically, when we're talking about sectors, we're looking at the sector allocation. So within the S&P 500 are different companies. These companies are also classified into different sectors, depending on what the company is doing, of course, right? The materials sector has given the best return, which is at 123%. So between that period, you would have gained 123% if you invested in that sector of materials. So if you looked for an ETF, a mutual fund that was only focusing on materials, you would have gained 123%, followed by the IT sector, which has given a return of 120%. That's an amazing return. So tell me where you get this kind of returns within 1 year. Nowhere. Stocks can make you rich. Stocks can make you money. You just need to be consistent, disciplined, and know what you're doing. Know what you're doing. That's very important. And then the financial industry has given 118%. The industrial has given 116%. Communications industry has given 102%. The consumer industry has given 102% too. The energy industry has given 101%. The real estate industry has given 84%. The healthcare industry has given 81%. The utility sectors has given 54%. Now, those are the kind of returns you could have experienced if you were just invested in some of these ETFs that track a particular sector. So that's really amazing returns. That's double-digit return. Now, let's look at some of the companies on my laptop that have actually performed quite well. Just a few companies that comes from these sectors that have given amazing returns. This is, of course, to just look at my stocks, do my analysis, look at the stocks that are performing well. As you can see on FinViz, sorry, I don't want to save. We're looking at the S&P 500, which is the Standard & Poor map. And then we're looking at the 1 year performance. Let's look at 1 year performance because there's no way. We can look at year to date. Let's look at 1 year performance. We just want to look at average. So we're going to take 1 year performance, and then we're going to have an average performance of that 1 year. So if you come here to the S&P 500, for example, look at the 1 year performance. Look at something like Microsoft. Let's look at the technology sector, basically. Yeah? The software and technology sector, you will find Microsoft is one of them. And look at the kind of returns you can see here. Let's see. You can see very good returns on the technology sector. You can see very high returns, 29, 56, 32% kind of return. The returns are just amazing. The returns are amazing. If you look at Microsoft, Adobe, Oracle, Snapchat, and stuff like that, all those have performed exemplarily well. Then you go to the communications sector and look at Google, look at Facebook. Google has given very high returns, 76%. And Facebook has given 27%. So these are some of the best companies in those particular sectors that you could have invested in. Look at entertainment industry, auto manufacturing industry. Tesla has given over 59% return. So basically, if you come here, it will show you different sectors and what the companies within that sectors have given you. So it's a very, very, very good way to look at the performance of different companies if you want to. So you could even just put a company, the stick of a company, like Facebook, for example. Look at Facebook, just Facebook, and look at the performance of Facebook. And it will give you all the details. Look at that performance. Look at that performance. Look at that performance. Amazing. So you can put, you want to check daily, you want to check weekly, monthly, time frame. Let's check monthly time frame. I think that's where we are now. So look at this performance with the Facebook. Look at that. At some point, Facebook was 66. Now we're talking about 372 a share. Actually, it's more than 372. 373 a share. Let's check. It's Facebook. And then you can come here and look at every detail that you want about it. It's in the S&P 500, the market cap, the income, the sales. You can look at all the details you want of Facebook here. Every single thing that you may want to know about Facebook. Very simple, very direct. So if you want to screen any kind of stocks, you can come here and screen any kind of stock, basically. Let's look at Apple. So basically, this place will just show you some of the best performing companies. If you want to scroll down and just see some of the best performing companies, how the different sectors have performed, the kind of returns they've given, and how they got the averages in terms of what we've just seen. So if you invested in some of these companies just 1 year ago, you'd have made really good money. If you invested in 10 years ago, for example, then you would have made even better. So if you were to just look at, even though this will not show us a 10-year example, but if you go and look for the graph of most of these companies and look at the returns in 10 years, you realize that you would have made really good money. I think Amazon, Apple, Microsoft will have made amazing growth. Tesla have made amazing growth in the last 10 years. So you'd have definitely made money. Anyway, guys, this was just to show you that, you know what, don't fear investing. Start investing today. Always know that when the market is crumbling or is tumbling down, it will always go back up. If it comes down, it will always go back up. Take advantage of it when it comes down. Buy as many shares as you can and wait for your money to double. That's how you invest. You invest by taking risks, guys. Otherwise, thank you. Let me know what you think. As usual, comment below and see you next time.